Welcome to Investors Insights. Our topic today is 2023 and you. We have got some great conversations going on this morning in regards to market performance, interest rates, and also the stock market in relation to employment. My colleagues, Bobby Norman, Trey Booth, and Tom Miller and I have just finished an incredible meeting, and it gives you insight on details and data that you need to be aware of as we start this 2023 year. Bobby, I'd like to start off with you because I thought you gave some great comparisons from a historical standpoint, as well as the possibilities going forward based on historical data. So no guarantees, but we also think it's good to look at how the market reacted, especially after the 2022 year in comparison to other markets. So show us the charts you showed me this morning. Very impressive.
Yeah, we hope that everyone is having a great 2023 so far. But before we get into our thoughts for 2023, I want to take a quick minute to summarize the market in 2022. I think the best way to describe last year is the word volatility, as we saw a record amount of volatility, not only in the stock market, but also in the bond market, where bonds saw one of its worst performing years in history. So just looking at some returns from last year, we saw the S&P 500 down 19.4%. The NASDAQ was down 33.1%, and the aggregate bond index was down 13%. Also, international markets didn't fare much better, with an example being emerging markets, which ended the year down 20.6%. So where does last year stand up in relation to history? And as you can see in this chart, going back to 1928, there have only been 6 years that saw the S&P 500 perform worse than it did in 2022. So going forward, we expect some of the same headwinds in 2023 that we saw last year, with the biggest headwind continuing to be the uncertainty around the Federal Reserve raising interest rates to fight inflation. So while every year is different, we took a look back at history to see how the market historically has performed after years like we saw in 2022. As you can see in this chart, and more specifically, the third column from the left, historically, the market has seen an average 26% return in the year after the market has been down close to 20% or more in the previous year. So listen, no guarantees, but we're hopeful that we will have a more favorable market in 2023, even with some of the same headwinds from 2022 remaining.
Yeah, and Bobby, I love this chart for numerous reasons. One, we've got clients who have lived through some of these years. Number two, from a career standpoint, getting in the industry in 1981, 82, from the standpoint of what took place and when interest rates increased. It's interesting to watch people, how they've reacted to this current increase. And I'd like to say to folks, this too shall pass. We will navigate through this and looking at this. But I thought this chart was fantastic. And then it really complemented, Trey, what you were talking about in regards to interest rates and mortgage rates and how our clients have been impacted. And going back to our theme, 2023 and you, talk about that, how our clients have felt that in terms of portfolios, but also just day-to-day living and mortgage rates.
Yeah, absolutely. So yeah, it's definitely not a secret, especially for those that have been watching our vlogs all year, that the interest rate environment has been challenging and rates have moved up drastically over the last year. So instead of going through each interest rate environment and the different types of bonds, I thought it'd be helpful to show two charts that I feel like, as our investment committee looked at, were the most telling of what happened last year. Let me start with the mortgage rate. So this chart shows the national average 30-year and 50-year mortgage rate. Opened the year at around 3.22%, ended the year at 6.3%. There were large parts of the year where we were above 7%. So we've actually kind of come down a little bit. But to put that in dollar terms, that's about $200 per month for every $100,000 of borrowing for someone that wanted to borrow. So if you were looking at a $500,000 house, that's $1,000 a month, every month for 30 years in additional cost. That really hits people's bottom lines very quickly. And so, you know, we did a specialty vlog on the impact of mortgage rates and housing. So this is really starting to hit people really where it hurts, you know, basic housing. Then from a market standpoint, the most impactful chart is showing the amount of negative yielding debt. This just shows how extremely abnormal the last decade or so has been. Coming into 2022, at the end of 2021, there was 14.1 trillion with a T negative yielding debt instruments around the world. What that means is you buy an investment knowing for a fact that if you hold it to maturity, you will lose money. That seems almost counterintuitive to investing just in general. Now that number is down to zero. So looking forward, we're in a much more normal environment. The transition to here was definitely painful as Bobby went over the numbers, but looking forward, this is a much more normal environment for investors. You can get a return on your conservative investments versus the markets. And so we're looking for a more normal year looking forward.
Yeah, that would be fantastic. And I thought your data was right on, Trey. And let me say this to our viewers. Around February 9th, we're going to be, prior to that, we're going to be sending out invitations. We're going to be doing our investors' insights. And we will be doing additional data like you're hearing this morning, in which either in person we will speak, or we will also have some virtual meeting as well for all our clients throughout the country. So just know that this is the kind of research we do here at Five Plan Partners on a day-to-day basis to let you know what's important. That said, Ty, you really hit home as well. Trey talked about the mortgage rates, but the stock market in relation to employment. Last Friday, we saw something, and elaborate on that to give people some insight as to how it all works.
Yeah, after a sluggish start to open the year, we saw a hard rally on Friday. And so, what kind of led to that rally is something to dive into and something I wanted to share today. We got the employment report, and you're probably thinking, man, with that rally on Friday, we probably got one heck of an employment report. It just depends on which way you look at it. The headline numbers, payrolls increased 223,000, a little more than expected. Unemployment rate was down at 3.5%, which is very low. The labor force participation rate rose, which was a great sign. But the main takeaway is how the market reacted to the wage number. So wages rose 0.3% month over month. It's under 5% year over year now. And so while that does hurt the working, consumer, wages not growing, and with inflation still fairly high, the stock market took that in stride. And why? Because the Federal Reserve, that's something that they have been keen on. They cannot handle supply and demand, but they do pay attention to inflation, and their job is to stop inflation. So if wages were one of the sticky points of inflation thought to be, if those are going to start coming down or moderate more than expected, there's no reason for the Fed to further keep raising rates at the 75 basis point level and the 50 point basis level that we've seen. And that's what the market is kind of hoping for and taking from this report. So, that would be a good sign. On top of that, we got some further confirmation from the ISM manufacturing number, service inflation decline, production, kind of fell off the map there, all of a sudden. And so while these aren't necessarily, unbelievable numbers for the consumer or for, the average day working person, stock market really took it in stride because of how the Fed should react to it or is thought to be reacting to it in the future.
Yeah, no, it's great insight as to how all the different points of data that we look at come together, work, what the Fed's looking at. We don't like to get so detailed that we lose you in this blog, but from the standpoint, you need to know that's how detailed we get here at Five Plan Partners as we analyze people's portfolios in relation to their financial blueprint. Also, I just want to say on our social media, on Twitter, LinkedIn, Facebook, our podcast on YouTube, we're going to continue to grow that, communicate with you in those ways, as well as the virtual meetings and in-person meetings and personal phone calls. We're all about that. We're looking every day to see how we can communicate, as well as our processes and systems to make them effortless, limitless, and frictionless. And I also want to say this, I'm very excited. You can see my books here, but we've had people calling in saying, hey, Greg, can I get a copy of your book? I've got somebody I want to share this with. They're making New Year's resolutions on their financial planning and their goals. Please feel free to call us, ask for Felicia, ask for Renee. If you want a copy of the book, and if you need me to personalize it, I'm doing some today and more than happy to do that. We're excited about the 2023 year, and we're excited to have the opportunity of working with you. And as we move forward here, we'll continue to give you a lot of information that's beneficial, and hopefully you can share with others. Have a great week. We look forward to talking to you. And always remember, every day we're in this building to make our clients' lives better, richer, fuller. Thanks.